A trading system wins 7 times out of 10. That sounds strong. It sounds safe. It may even look impressive in a product headline. But after 100 trades, the account is lower than where it started. How can that happen? The answer is not mysterious. Win rate tells you how often a trade wins. It does not tell you how much the wins pay, how much the losses cost, or how much execution removes from every result. Today, we will turn those missing pieces into one practical number: trading expectancy. Imagine 2 traders. The first wins often, but closes each winner quickly and allows every loser to reach a large stop. The second loses more often, but keeps losses controlled and lets valid winners travel farther. If you only compare win rate, the first trader looks better. If you compare the money produced by a full series of trades, the second trader may be much stronger. A percentage of winning trades is descriptive. It is not a complete measure of edge. Expectancy combines frequency and size. In simple terms, multiply the win rate by the average win. Then subtract the loss rate multiplied by the average loss. We can measure the result in R. 1 R is the amount you plan to lose if the stop is hit. If a trade risks $100, then 1 R equals $100 for that trade. Using R lets us compare trades without confusing the analysis with different lot sizes. Now look at System A. It wins 70% of its trades. Its average winner is only 0.5 R, while its average loser is 1.5 R. The calculation is 70% multiplied by 0.5 R minus 30% multiplied by 1.5 R. That gives positive 0.35 R minus 0.45 R. The expectancy is negative 0.1 R per trade. The high win rate does not rescue the poor payoff structure. Over 100 trades, the simplified picture becomes obvious. 70 winners at 0.5 R produce 35 R. 30 losers at 1.5 R remove 45 R. The result is negative 10 R before spread, commission, slippage, or overnight financing. A long winning streak can make this system feel comfortable. 1 or 2 full losses can then erase many small wins. That emotional comfort is exactly why win rate can be such a persuasive distraction. System B wins only 40% of the time. Its average winner is 2 R, and its average loser is 1 R. 40% multiplied by 2 R equals positive 0.8 R. 60% multiplied by 1 R equals negative 0.6 R. The expectancy is positive 0.2 R per trade. Over 100 simplified trades, 40 winners produce 80 R, while 60 losers remove 60 R. The net result is positive 20 R before costs. System B may be mathematically better, but it can feel much harder to trade. 6 losses out of every 10 trades means frequent frustration. A trader may cut winners early just to feel relief, widen a stop to avoid another loss, or abandon the system shortly before a large winner arrives. This is where psychology meets mathematics. A positive edge only matters if the execution preserves the assumptions that created it. The required win rate changes with the payoff ratio. If the average win and average loss are both 1 R, the break-even win rate is 50% before costs. If the average win is 2 R and the average loss is 1 R, the break-even rate falls to about 33.3%. If the average win is only 0.5 R while the average loss is 1 R, the break-even rate rises to about 66.7%. There is no universally good win rate without the average win and average loss beside it. Now subtract trading costs. Suppose a strategy has positive expectancy of 0.1 R per trade before costs. If spread, commission, slippage and financing average 0.06 R, only 0.04 R remains. A small change in execution can remove the entire edge. This matters especially for fast strategies with tight targets. MetaTrader reports average profit trade, average loss trade, expected payoff, and profit factor, but you still need to confirm that the test reflects realistic costs and broker conditions. The practical fix begins with consistent records. Write each completed result in R, not only in dollars. A $200 gain may be excellent if the planned risk was $100. The same gain may be poor if the planned risk was $1,000. R reveals the relationship between the result and the risk accepted to obtain it. It also lets you combine trades taken with different stop distances and position sizes into one comparable series. Next, respect sample size. 20 trades can create a very attractive win rate by chance. Another 20 can make the same strategy look broken. 100 trades usually tells you more than 20, but even that number is not a magic guarantee. The right sample depends on trade frequency, market coverage, and how stable the logic is. Instead of searching for one perfect threshold, watch whether expectancy, average win, and average loss remain reasonably stable as more trades are added. A positive system can still produce ugly losing streaks. With a 40% win rate, the probability of 5 losses in one specified block is 0.6 to the 5th power, or about 7.8%. Across a long sequence containing many possible blocks, seeing at least one such run becomes more likely. This does not predict the exact next streak. It simply shows why a trader must size risk for sequences, not for a single trade. Position size determines whether normal variance is tolerable. Risk 1% of current equity per trade, and 5 consecutive full losses leave about 95.1% of the starting account. Risk 5% per trade, and the same 5 losses leave about 77.4%. That is a drawdown of roughly 22.6%, requiring a much larger percentage gain just to recover. The entry signal did not change. Only the risk applied to it changed. A cleaner process chooses the account risk first, defines the invalidation point, and then calculates position size from the stop distance. Reversing that order is dangerous. If you choose a favorite lot size first, a wider stop quietly increases the money at risk. For automated systems, confirm whether the lot setting is fixed, based on equity, or based on stop distance. 2 EA systems using the same lot can carry very different risk when their protective stops are different. Do not evaluate the entry in isolation. Moving a stop farther away increases the average loss. Taking profit early reduces the average win. Skipping valid trades changes the sample. Adding revenge trades introduces a different strategy into the record. In an EA, break-even logic, trailing stops, partial exits, and time filters are part of the system. In manual trading, your behavior is part of the system. Expectancy measures the process that was actually executed, not the rules you intended to follow. For a compact review, record 7 lines: total trades, win rate, average win in R, average loss in R, expectancy in R per trade, maximum losing streak, and estimated cost per trade. Then add context such as symbol, session, and market condition. These lines tell a much clearer story than win rate alone. They also make it easier to compare a backtest, a demo forward test, and live results on the same scale. After calculating the overall expectancy, split the data. Compare months, trading sessions, long and short positions, calm and volatile periods, and older versus recent trades. A positive total can hide one strong segment carrying several weak segments. The goal is not to delete every bad period after seeing the results. That creates overfitting. The goal is to understand where the edge appears, where it weakens, and whether the explanation makes sense before changing the rules. Increase risk only when the evidence is broader than one good streak. Look for positive expectancy after realistic costs, a payoff structure that remains stable as the sample grows, and a drawdown you can tolerate without changing the plan. If live average loss becomes larger, average win becomes smaller, or costs rise, reduce risk and investigate. This is not a promise that the next trade will win. It is a process for avoiding large decisions based on one attractive percentage. So the next time you see a 70% win rate, do not reject it and do not trust it automatically. Ask what the average win is. Ask what the average loss is. Ask whether costs are included. Ask how many trades created the result and how large the worst losing sequence became. Win rate is useful. It simply needs the rest of the equation beside it. If this explanation helped, subscribe to Atsushi K. Forex Lab for more practical videos about Forex research, MetaTrader 5 tools, backtesting, and expert advisor development. Trading Forex and CFDs involves substantial risk. This video is for education only and is not financial or investment advice. Historical, backtest, and example results do not guarantee future performance.